If you had a crystal ball that could tell the future, how could you use it to make money? Well, you could buy stock in a company that you knew was going to have a good year. If you bought $10,000 worth of NVIDIA stock 1 year ago, you would have around $23,000 today. But that's only $13,000 in a year. And you had to have $10,000 to start with. There must be a more efficient way to use this thing. It's a magic ball, for crying out loud.
Apparently, a lot of investors felt the same way and wanted a more flexible, fluid way to bet on the future than just buying and selling stocks.
Enter derivatives, financial instruments that derive their value from some other underlying asset, like stocks or mortgages.
Derivatives are considered advanced investing, and once we start explaining them, you'll see why. Not only are they complex, but also abstract in nature, which makes them hard to understand.
Even with a crystal ball.
So before they go too far into this segment, I would caveat that I'd highly discourage anybody from getting into options. This is, as far as I can tell from any research that I have done on it, basically advanced gambling, where you are potentially trying to trick yourself into believing that there are signs or signals or mathematical formulas that you have that will show you what will get you to become rich very quickly. But effectively, it's really just gambling. You end up putting portions of money down, and then because these transactions require little upfront and can have very high returns, kind of like a gambling situation, it encourages people to do it. And then once you win or execute an option properly and get a gain from it, you are likely to then spend the money you just earned until eventually you lose. And that seems to be the vast majority of the cases that I've seen from individuals. Is they go through this gambling mentality of they win big at some point, they keep going, and then they basically lose it all. And then hopefully at that point they have learned their lesson and stopped using it. So again, highly discouraged, but we'll see what they have to say on this topic.
According to legend, the first derivative in recorded history was chronicled by Aristotle over 2,000 years ago. He told the story of a philosopher named Thales who used his knowledge of the heavens to predict that the next season's olive crop would be bountiful. There was no stock market in ancient Greece, so he couldn't buy shares in olive companies. But what he could do was pay a small fee to reserve all the olive presses in the area for next season's harvest time. When the giant crop of olives eventually came in, Thales had the market cornered.
Thales' strategy could be seen as the ancestor of the modern derivatives known as futures and options. In simplest terms, a future is a contract between two parties to make a transaction at a certain price at a certain time in the future.
Let's say lemons cost $2 a pound. But little Tina is worried that the price will go up, so she makes a deal with Sam the grocer to buy 100 pounds of lemons at $2 a pound 1 year from now. That agreement is called a future. If she's wrong and the price goes down, she'll be forced to buy the lemons at above market price. But if she's right and the price goes up, say to $3 a pound, Sam will be forced to sell her the lemons at below market price. Tina can now use the lemons to make lemonade, or she can turn around and sell them for $3 a pound and pocket the $100 difference.
In reality, most futures do not end up with a physical delivery of goods. Rather than buy the lemons and sell them to Tina so she can resell them, Sam would just pay Tina the $100 in cash. It's a much simpler way of settling up. In fact, Tina probably wouldn't even be holding the future by then. As soon as prices started to go up, she could sell it to a third party and realize the profits sooner. That third party might sell it to someone else, who'd sell it to someone else, and so on, with the value of the future fluctuating depending on the current price of lemons.
If you think this sounds less like a transaction and more like two people betting on the price of lemons, well, you're not wrong. Futures have become so theoretical that the underlying asset is often not an asset at all. So-called event futures allow you to bet on all sorts of things, from extreme weather to politics. You can buy a future on the amount of snowfall the Midwest will get this winter, or whether Congress will ban TikTok.
Not everything is fair game, though. The policy analysis market was designed to allow people to buy futures on various political developments around the world, including movement of troops in and out of Middle Eastern countries and political instability. Supposedly, this would help the US government make informed decisions regarding defense policy. But the idea led to fears that people would essentially be placing bets on terrorism in a terror market.
Futures based on box office returns are also banned because movie studios worried their rivals could use the tool to sway public opinion. And just recently, the Commodity Futures Trading Commission proposed a rule change that would forbid the trading of futures on the outcome of elections, fearing that gobs of Wall Street money might corrupt our democracy. Can you imagine?
Options are
Definitely could not imagine that at all. There's almost zero chance that there's any corruption going on in our government based off of organizations with huge amounts of wealth. That definitely can't be the America that I live in.
similar to futures, with two important distinctions. First, options typically only apply to stocks, not lemons or snowfall or presidential elections. Second, options give the buyer the right to buy or sell a stock at a certain price in the future, called the strike price. But it's not an obligation. If the holder of an option doesn't like how the stock price has changed, they can choose not to exercise it. Obviously, this puts all the risk onto the vendor of the option. So the buyer must put some skin in the game in the form of a premium, which they don't get back whether or not they exercise the option.
Edgar here just heard that his favorite fast food chain, Patty's, is planning to introduce a new plant-based burger. He's sure it will be a disaster, so he decides to buy an option to sell, known as a put option, 100 shares of Patty's stock at a strike price of $20 per share in 3 months' time. At $2 per share, the premium will cost him $200. The plan is that once Patty's stock price falls, he'll be able to scoop up 100 shares for cheap and then sell them at $20 per share for a nice little profit.
Unfortunately for Edgar, the plant-based burgers are a hit, and Patty's share price rises to $25 by the end of the term. Edgar's option is essentially worthless. He chooses not to execute and eats the $200 premium as a loss. On the bright side, if it had been a future instead of an option, he would have been forced to sell 100 shares of Patty's stock for $20, which would have cost him $500 instead of $200.
Traditionally, options and futures were used as a hedge, a way to...
So it's actually a very interesting explanation there. So I think basically the distinction that they made was futures basically is a promise to go through, whereas an option is, I guess, as the name implies, the opportunity to follow up with a particular type of sale. And so you just have to pay a premium for the opportunity to do so. I guess, again, similar to gambling, you have to place a minimum bet in order to actually enter into the game, so to speak, and potentially win money. So those are definitely interesting options. But as they've already highlighted, it basically requires you to make a prediction about the future and then hope that that prediction is accurate enough that you get a benefit from it. And so this is where it, again, is effectively gambling, where you're putting money down in order to hopefully get an outcome that is beneficial to you based off of what you thought in the past by the time you get there. And there are consequences if it is not the way that you had planned initially. And so again, this is where it usually becomes gambling. Usually, if you talk to somebody who does this, they have a trick or something. I think charts, they usually have these like fancy graphs with a bunch of colors, and they have lines, and they're like, if it goes above this line or it turns this color at this time, that's, you're going to make a bajillion dollars or whatever their trick is. And so usually everybody loses at this in the long term. So definitely still discouraged.
to reduce the risk of loss in a volatile market. If a farmer is worried about a potential drought that could ruin his crops, he can buy a weather future that will pay out if this happens, minimizing the damage. However, they're increasingly being used as a speculative tool, a way to increase one's risk and potential reward. For instance, you could buy stock in an up-and-coming company and then buy a call option on the stock so that if the price goes up, like you hope, you'll hit the jackpot.
There are also claims that futures and options help make the market more efficient. Having all these big brains gambling on the price of lemons supposedly gives us a more accurate idea of what lemons are actually worth. And allowing money to flow more freely allows the market to react more dynamically to changing conditions.
So they didn't seem to go through hedging as much. So this is where oftentimes, if you get super advanced, you can basically make conflicting predictions about the future. And this is where some people make these attempts by basically saying, we'll go with an easy case where the price will go up. They make a particular bet, and then they make another bet that the price will go down. And so what this ends up doing is if they end up losing the bet that says the price is going to go up, then their bet saying that the price is going to go down basically can offset the losses of their original bet. So this is where they double their bets in order to have basically higher win options. But again, this is kind of where, if you go back to gambling, this is where you just make multiple bets on various scenarios and you just increase how many scenarios you're doing it. But sometimes people do this strategically in conflicting opinions. So for like the election, they could have placed a bet on Trump winning, and then maybe they put a bet on Kamala Harris winning. And then therefore they would have some winnings one way or the other. And that the other bet would kind of de-risk it in their mind of minimizing how bad losses could become.
Derivatives remain extremely perilous for individual investors. Not only are they much more complex than other financial instruments, they also allow you to take on a large amount of risk with a relatively small deposit.
Many economists consider them just a form of gambling, and Warren Buffett famously called them financial weapons of mass destruction.
That's a pretty severe stance on derivatives, but I think Warren Buffett's usual advice for the average investor, I think, is pretty solid. And agreed, this is usually something that I've seen taken very poorly, and usually by a similar group of individuals who are into sports betting will do options or some type of derivative, and the same behavior will ensue, which is they see the big potential, they invest some money, put some money down in order to try to win it big. Then they end up losing, and then they try putting in more money to make up for the loss. Or even if they do win, they spend all the money that they won, trying it again to see if they can double their money or triple their money a second time, because then that would be such a huge win. And again, it's similar mentality as far as I can tell to actual gambling.
Even if you're experienced enough to understand what you're getting into, there's also the small problem of predicting the future,
which humans have never been very good at.
And that's our 2 cents. Before you go, we wanted to share that PBS Digital Studios just released our very first TV show. Our friends over at Terra just launched Weathered, Earth's Extremes on the PBS app and on PBS stations around the country.
In it, Maya May and the Weathered team travel around the world and tell the definitive story about our changing weather and climate, and how a better future is within reach.
This show is a must-watch for anybody who wants to understand where we stand in the fight against climate change.
If you want to support PBS Digital Studios, head to the link in the description to watch the show on the PBS app. It is 100% free to watch, along with a ton of other incredible series.
Think of the PBS app as the people's streamer. It's one of the best places for documentaries from Nova, Frontline, and more, as well as episodes from our PBS Digital Studios friends like Eons, Be Smart, Crash Course, Monstrum, and yes, 2 cents.
Thanks to our patrons for keeping 2 cents financially healthy. Click the link in the description to become a 2 cents patron.
Thank you for watching. If you enjoyed what you saw, please hit like or subscribe. I'll see you around.